Okay, traders, welcome back. So in this video, we're going to be going over how to trade a choppy market, right? So the amount of times I've been stopped out as a trader, in these moves, only for the real move to happen, is one of the most annoying things, right? So the first thing to understand when you're trading a choppy market is you need to be willing to let your trades breathe. And so what I mean by that is you need to be having slightly wider stop losses instead of those tighter stop losses. Those tighter stop losses will give you a higher risk to reward when in reality, what you want is a winning trade. Now, chasing a higher risk to reward often will yield you the opposite result of getting a winning trade. Simply put, if you're trading a range, increase your stop size, right? It is that simple. Now, we're going to be breaking this down on NASDAQ, all right? So this is the 15-minute chart on NASDAQ or NQ, right? Futures chart. So let's kind of break down how I do this. So there's a couple of things I use, right? When I trade, my strategy is very simple. A simple strategy will yield you the most repeatability. And as traders, we want to be repeatable, not necessarily always correct. When I mean correct, I mean in terms of your P&L. So I always trade with a 15-minute fair value gap. Then I look for a 1-minute entry, or I sometimes call it a 1-minute PO3 entry. And we're going to explain what that is. And then we're going to be using order flow. Now, you need all three to make the strategy work, and you need all three to make any strategy work, right? Now, more broadly, this is a key level. You need an entry into a key level, and you're looking for confirmation. Now, confirmation can only really come via the order flow footprint charts, right? So if we this is the ATAS platform. So on the order flow footprint charts, I will break this trade down again. So this same trade is on the ATAS platform over here. And notice how the ATAS platform gives you the same exact candles, but you can zoom into the candles, right? This is what makes your trading unique, right? So if you find yourself getting to a fair value gap or a support and resistance, and you don't really know what's happening, you're leaving your trading to chance, i.e. you're gambling. So a quick way to avoid gambling is to understand what is going on at key levels, right? So what we can see over here is we can see price bouncing higher in this rangy market. So what's interesting here, if we kind of dive into these candles a little bit, what I want traders to understand is we are going to be breaking down the science and the logic behind this. So notice how we have 1, 2, 3, 4, 5, 6, 7 candles on the 15-minute chart before the move higher. So that's about an hour and a half or even close to 2 hours of ranging. So we're going to figure out how we can kind of get around this, right? How to trade a choppy market. And so the first thing to understand is when you're trading a choppy market, you need to be very precise with your key levels. So how do I form a key level? How do I know where I'm trading from? A common question I get is how do I form my points of interest, my POIs? And so a 15-minute fair value gap is essentially my POI. So I like to use POIs. I like to use power of 3, right? POI and power of 3. I also like to use liquidity. And we're going to break down what I mean by liquidity. And so let me just first bring on this. This is the Asian range, all right? This is the Asian range. So what you can see straight away from here is a couple of things. We can see price has swept this Asian low, right? We've taken out this Asian range low. Now, when we take out an Asian range low, the market will very often take out the Asian range high. This is just a quick tip, right? ICT traders know this. A lot of different types of traders know this, right? Once price has taken out the Asian range low, you want to look for price to take out the Asian range high. So that's the first thing. The second thing is we're looking for a 15-minute fair value gap, right? And I'm going to quickly break this down. We are anticipating the low of the day just over here. We're looking for that low of the day below the Asian range, okay? The next thing we're looking for is a 15-minute fair value gap. So how does this actually work? So notice how price leaves a fair value gap over here. So if this is the fair value gap, I'm going to label it in blue. That is the FVG, that is the fair value gap. And so how does the point of interest differ from the fair value gap? And so the point of interest will look something like this. This over here is the point of interest. So my point of interest is always the candle before the fair value gap, right? It's always this way. This is how I form my points of interest. So there's three things I use. The first is the Asian range in liquidity. The second is a 15-minute fair value gap. The third thing, and this is where we kind of move on to point 2. So first we have a 15-minute fair value gap, a POI. The next thing is we're looking for a 1-minute PO3 entry. So what a PO3 entry actually means, if we just go down to the 5-minute chart, right? So we've anticipated the low of the day and we've tapped into our key level. Now, the third thing is this, power of 3. So for those who don't come from an ICT background or whatever you want to call it, right, the way that a power of three works is that you have the candles open, which is over here. Actually, let me give you a better analogy of this, right? So let's kind of go here. So as we come into this key level, what you can understand here is that you have the low of the day, which is after the Asian range. We have the open, and then we have the high of the day. So the way that a candle works is like this. And if you can understand how a candle works, you'll be able to trade any market, any session, and avoid getting chopped out. So that's kind of how we do it. So the way we do this is you want to understand a candle will open, a candle will go down, it will create the low of the day, and our job is to essentially buy anywhere near the or below the daily opening price. So this is the daily opening price. I use the PO3 indicator, right? PO3 by 2 degrees. If you go to indicator and type in PO3, you will find PO3 by 2 degrees. This one right here, higher time frame PO3, 2 degrees, right? So that is what I am using. So that's what we call a PO3 entry. So a PO3 entry simply means we're waiting for price to enter, and we want to be below the daily opening price. So once price enters, we're now understanding the interactions between the buyers and the sellers. And that is kind of step 3, right? So once we have our 3 things established, I call this a triple X model. So a lot of traders overcomplicate their systems by using indicators, multiple patterns, ICT concepts, and the list goes on. All you need is 3 things to make this a consistently profitable mechanical strategy. You need to know where to trade from, what to look for, and why you are looking for it. Where, what, why. And I call this the triple X model. You need to know where you're looking from, what you're trading, what you're looking for, and why you're looking for it. Where, what, why. The why is my favorite part of trading, and it's essentially why the market moves up and down. And so the market moves up, we're going to be going over a buy case study. The market moves up only because of one reason. All right, and if there's nothing you take away from this video, is you want to understand at this level, buyers are in control, right? Buyers are in control. And the way we know buyers are in control is because we understand that there's passive buy limit orders, right? There's passive buyers, right? Or you can call these limit orders. So this is why the market moves up, right? There are buy limit orders resting in and around this key level. The question now becomes, how do I know there are buy limit orders resting in this point of interest? Well, the only way you will know that, right? The only way you will know that is by understanding this chart over here. So here's NQ. This is on the 15-minute chart. What we're going to do is we're going to drop down to the 5-minute chart. Now, when we drop down to a 5-minute chart, I get lots of questions about my entries, right? What time frame do I use? Which time frame do I use? I use the 1 minute or the 5 minute, depending on, I guess, which one is cleaner, right? So if we, 8 hours doesn't let me go far that back. We use the 15-minute, it's fine. So when we use the 15-minute chart, let's kind of understand what was going on, right? So what we're looking for essentially is the following price action, right? So we want to understand price is wicking above and wicking below, right? So we want to understand what's going on as price rejects this level. And this is what we're going to be looking at. We want to understand what's going on as price rejects this level. So just as an overview, without even reading the numbers, you can understand inside of every candle, there's aggressive buyers and aggressive sellers. And the way you make this, from a trading perspective, the way you make this valid is you're looking at essentially the wicks and the rejections below the key level, right? This key level over here. And you don't need to read every number. You only need to read a few numbers where there's a lot of red delta. So just off the top, just by glancing at this, you see red delta here, outlier here, and an outlier here. Let's start with this one to the left. What you're seeing is 273 for 210, 233 for 170. So you're seeing 2 regions where sellers are aggressive. You see the same thing over here, 212 for 102. That's more than double, right? That's a 2x difference between the aggressive sellers and buyers. You see the same thing over here. You see 160, well, if I've zoomed in, you see 168 for 60. So you're seeing a lot of aggressive sellers inside of this region. Despite that, you see price breaking to the upside. So you see 1, 2, 3 retests, and you see a lot of aggressive sellers, but the market breaks higher. So when you look at this on the regular candlestick chart, I guess what you really want to understand, right? Oh, I played around too much. What you really want to understand, what you really want to read, is the concept of what's going on over here, right? So you saw all these rejections down here. I'm going to put this in red so you can see that. You saw multiple rejections in and around this region, right? So how does that tie up to what we're looking at on the ATAS footprint charts, right? So, right, this red box over here represents this entire region over here. So you can see this red box over here is full of aggressive sellers. So do you remember earlier when I spoke about the fact that buyers are in control? How do we know buyers are in control? Well, what's really going on here, and I want traders to really understand this. We saw a ton of aggressive sellers where the red box is, right? This red box here represents a ton of aggressive sellers. So these aggressive sellers could not really sustain price lower, because if these aggressive sellers over here were successful, they would have broken price below the Asian range, but they didn't. So this is what we call an absorption, right? Absorption of sellers, right? What does that mean? An absorption of sellers, simply put, simply means that sellers are not in control. They're aggressive, but they're being absorbed, right? They're hitting what we call a demand or a support. They're hitting a support area over here, right? Price is bouncing off, right? 1, 2, 3, 4. Bearing in mind, this is a 15-minute chart. So we're seeing 15, 30, 40. We're seeing an hour of bouncing around this area. So we know on NQ between 23,403 and 23,000. So round about the 400, 390 region, we are seeing significantly more aggressive sellers. Therefore, the absorption of sellers tells us that there's buy limit orders resting in this region. So very simply put, we are seeing that sellers here are aggressive, right? These are aggressive sellers over here. Now, have they been rewarded? No, because they would have driven price down here, or they would have at least driven price into this fair value gap. They couldn't sustain lower prices. So what that means is that these aggressive sellers, I'm just going to write AS, aggressive sellers, have failed. That means, right, when you see price breaking to the upside, you can take an entry here, or in a choppy market, you can take advantage of the volatility and you can enter here. Either way, I would want my stop loss below here because we're trading a choppy market, and you take a slightly lower risk reward, right? You can take a 1.5R, for example, right? 1.5R is my favorite risk reward, especially in choppy markets like these. So once you understand where there are buy limit orders, you can trade, right? You can trade. Obviously, we had a gap up, so we had a very, whatever, it was very bullish after that. What's important to understand is that once you have your key levels, price will often gravitate back towards those key levels before, heading higher again, right? So the reason why price came into this area is because we knew already there were passive buyers resting over here, right? So we established that from the order flow footprint charts, right? So let's quickly go back and look at this. So what we saw over here, footprint charts, we saw a huge amount of aggressive sellers that failed. We saw them fail as price broke higher over here, right? So capitalizing on that move. Now, what's interesting is when you see price coming back in, we see this rejection. I want traders to study the rejection because the rejection is the best thing you can study, right? It's super interesting where we actually had a green candle, right? This was a green wick. Now, the number of traders who don't understand a wick is alarming. So let me explain to you how a wick actually works. When you see a wick forming like this, right, what that means is that aggressive sellers have failed, right? So I'm just going to write AGG. Aggressive, let me just write it like this. Aggressive sellers have failed, which means that passive buyers are in control, right? Passive buyers are in control of the price. And so this is the reason the market rallied higher off this demand. So it's not an accident you see a wick and a rejection higher off a 15-minute fair value gap over here, right? This is all part of basically trading, right? This is how the markets work. So your job as a trader is to identify key levels, entry at key levels, and you want to see whether your key level is going to be a demand or a supply. So in this case, it was indeed a demand area. There was demand at this area, which shot price higher. And so the reason for that, the reason why the market shot up higher the way it did is simply because of this, right? So when we look into here, I don't even need to read the numbers, right? I can see via the outliers, the market is aggressively selling off, right? You can see this. So 516 for 98. That is this wick over here. In fact, I'm going to zoom in so traders can understand exactly what I'm looking at, right? I am looking at this wick over here, right? So I'm looking at this wick, this one here. I'm going to highlight it in yellow. I'm looking at that wick. And so that wick is what's interesting to me, right? So this is the wick there. So you can see price entering with a wick. And what gives you the confidence that this is a true demand area is this. 516 for 98, right? What is the ratio? That's over a 5x ratio in the total number of aggressive sellers on the left and aggressive buyers on the right. So what that's showing you is that there's a huge amount of demand. The reason why is because we saw this massive rejection, 516 for 98, and the market was able to break above the candle once and twice. So it shows you are at an area of demand, and it shows you the key level is an area of support or demand, right? And that is the reason the market essentially shoots higher. So gaps up like this, where you can see this massive gap up over here, happens when there's more demand than there is supply. All right, so I see traders talking about supply and demand. The only way you can see whether you're at a supply zone or in this case a demand zone is by understanding aggressive sellers have failed. They have been absorbed by passive buyers, right? Buy limit orders are resting in this region. Now when we go back to the candlestick charts, right? Clean charts is what I like, right? Clean charts. So approaching a rangy market is the easiest thing, right? Let me give you the steps. You need a key level of a 15-minute fair value gap. And understanding that the market will gravitate towards these key levels and give you multiple opportunities, right? So yes, we had an opportunity over here. I would keep my stop loss above the below the rejection wicks. And we also had another opportunity, super clean, over here. So again, how would I trade that, right? So how would I look to trade this rejection, right? I don't trade NQ myself. This is more of a case study. So I want to see how price reacts at the key level. So breaking this down one more time, when you see 516 for 98, and then you see price breaking to the upside on 1-2 occasions, you could take a long anywhere from this position, because what you've seen is a massive absorption of a large number of sellers, which shows you sellers have been rejected, which shows you that there's passive buyers at this level, which shows you that there's passive buy limit orders at this level, which tells you you want to be buying. So it's not a pattern or a fair value gap or a breaker structure. It's nothing like that. In reality, it is using the footprint charts to tell you who's in control. So you're not necessarily waiting for a breaker structure like this. This is going to massively hinder your risk reward, right? This is not going to help you. You're not looking for a breaker structure like this, right? This is wrong. You're not looking for this breaker structure. What you're really looking for is you're looking for a rejection off a key level, and you're looking for one candle break like this, right? Now from here, you can enter at the top of the candle. I would still keep my stop loss. Well, in this case, we have no fair value. This is the second thing, right? We don't have any 1 minute fair value gaps, right? All the fair value gaps have been filled over here. So you can keep your stop loss either here or just below the zone, right? And you can target, realistically, this was obviously a gap up day. I don't recommend trading gap up days. This is more of a case study for you to understand. I want traders to move away from trading market structures, and I want you to get used to trading fair value gaps with order flow, right? So this is one way to avoid getting chopped out in choppy market, is to understand exactly where the limit orders are actually present.